A bank is a mechanism for quantifying trust. At its core, it is an institution designed to transfer value across time and space. From the first grain loans in Sumeria around 2000 BCE to the late 20th century, this protocol required centralized custody. Trust was secured by physical fortresses and heavy steel vaults. Today, those vaults are being replaced by invisible networks. Data packets fire across global infrastructure at extreme velocity, settling transactions in milliseconds. We are witnessing a systemic architectural inversion. Trust is migrating away from siloed proprietary ledgers and into interoperable digital public infrastructure. Physical analogs of money are being swapped out for programmable, tokenized assets. To understand this shift, we have to deconstruct the mechanical evolution of financial intermediation. We need to analyze the heavy regulatory guardrails of Basel III and map the incoming wave of post-quantum zero-trust networks. Modern financial institutions find themselves caught in a defining friction. They are trapped between intense regulatory engineering on one side and algorithmic transaction velocity on the other. Survival in this environment dictates mastering this exact complexity. A modern bank must balance the heavy friction required for capital stability with the raw speed of artificial intelligence. The ultimate expression of analog, centralized banking occurred in India in 1969. It remains a definitive case study in direct state control and policy execution. Through a single midnight ordinance, the government seized 14 major commercial banks. Overnight, 70% of the nation's deposits were brought under state control. Prime Minister Indira Gandhi used this seizure to bypass her rivals, outmaneuvering the old guard syndicate leadership represented by figures like Morarji Desai. The state intended to pull credit away from urban centers and force it into priority sectors, specifically agriculture and small-scale industries. This physical infrastructure achieved massive rural expansion. By 2025, public sector banks had opened over 45 crore accounts, bringing millions into the formal economy. But this mandate carried a severe operational trade-off. Banks were required to provide long-term project financing, a function outside their original scope. This structural mismatch created immense drag. Over decades, it generated a gradual, systemic accumulation of non-performing loans across the sector. The state-led model expanded physical reach and inclusion, but it did so by layering legacy procedures onto a centralized bureaucracy. This accumulation of processing delays and bad assets became the systemic friction that subsequent digital reforms sought to solve. The economic liberalization of 1991 catalyzed this overhaul. It forced banks to abandon their stagnant 4-6-4 culture, borrow at 4%, lend at 6%, and go home at 4 p.m., and begin modernizing. The true architectural shift arrived in 2016 with the launch of the Unified Payments Interface, or UPI. This established the foundation of India's digital public infrastructure. This chart shows UPI transaction volume growth. In fiscal year 2018 to 2019, the system processed roughly 915 million annual transactions. By October 2025, volume exploded to over 20.7 billion transactions in a single month. The fiat value reached 27.28 lakh crore rupees monthly. On a macro scale, UPI now accounts for 85% of India's digital payments and nearly half of all global real-time transactions. The International Monetary Fund identified the core driver of this success, the architectural principle of strict interoperability. Interoperability effectively decoupled the transaction layer from the proprietary custody layer. By severing that link, it prevented closed system monopolies from dominating the network. In reality, an independent merchant can trust digital earnings instantly. The funds route seamlessly across any banking backend via a single, universally accessible interface. This infrastructure moved transactions out of private silos and into a shared network protocol. It transitioned money from an asset held in separate physical locations into a utility accessible from any device. As transaction velocity approaches infinity, institutions face a paradox. Global regulatory friction is being intentionally increased to slow them down. Following the 2008 crisis, the Basel III Accords were established to engineer resilience back into the international banking system. Under Basel III capital adequacy requirements, banks must hold a minimum common equity Tier 1 ratio of 4.5% against risk-weighted assets. Regulators also require a 2.5% capital conservation buffer, plus a 100% liquidity coverage ratio to survive 30-day stress scenarios. These rigid guardrails force banks to obsessively calculate their economic value of equity and net interest income under various simulated shock scenarios. This heavily regulated environment leaves legacy banks vulnerable. Neobanks, operating without physical branch overhead, exploit this friction using agile, cloud-first infrastructure. There is a wide gap in digital capability maturity. Digital native fintechs consistently score higher in customer satisfaction and transaction speed compared to traditional retail banks. To close this gap, traditional banks are aggressively deploying agentic AI. These are autonomous ecosystems capable of independent reasoning and execution. By utilizing AI to process alternative data and automatically verify compliance, banks are reducing loan approval times by up to 60%. They are also deploying digital memory orchestration. AI tracks the customer's context across every channel, solving the handoff problem by maintaining a single, continuous conversation. To stay profitable under these conditions, banks use AI-driven processing to maximize the return on the capital they are legally required to hold in reserve. By 2030, the technical layer underlying global finance is moving toward an on-chain, tokenized economy. Central bank digital currencies, or CBDCs, are driving this transition. Recently, central banks have pivoted away from retail pilots, focusing instead on heavy wholesale infrastructure. This map shows Project mBridge, a prototype for multi-jurisdictional wholesale settlement involving China, Thailand, the UAE, and Hong Kong. Tokenized settlement flows move directly between these central banks. This architecture explicitly bypasses the traditional US dollar-centric SWIFT network. The geopolitical implications are profound. This direct routing facilitates de-dollarization and lays the groundwork for a multipolar global payment order. At the domestic level, India's e-rupee pilot is introducing programmability. Funds can be hard-coded for specific purposes, ensuring that direct benefit transfers are spent exactly as intended by the issuer. When these tokenized networks interact with AI agents, they allow for autonomous finance, a system where software handles the optimization and execution of payments without manual user intervention. CBDCs integrate the rulebook directly into the currency. They create a system where the asset itself contains the code for its own distribution and settlement. As finance becomes entirely digital and frictionless, physical perimeter security is rendered completely irrelevant. The most critical threat to this global ledger is the rise of quantum computing and its sheer computational power. This threatens to render current RSA and ECC encryption methods obsolete within a matter of years. Organizations must rapidly adopt post-quantum cryptography to protect their data, while simultaneously implementing zero-trust architectures. The core premise of zero trust is to never trust and always verify. Every access request is scrutinized, establishing identity and behavioral patterns as the only viable firewalls. For 10,000 years, the mechanism has evolved. Whether utilizing clay tablets, state-run bureaucracies, or quantum-resistant ledgers, the technology is merely the vehicle for banking's enduring social contract, the institutionalization of trust.